Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant, co-host and host, depending who I'm talking to, of the Smart Property Investment Show. Welcome back. Hope you're well as we looking down the barrel of the end of the year. And I know a lot of people are already thinking about what Christie's going to look like and plans they're going to have over that time, whether they're going skiing in Japan, which seems to be the flavour of the year, and I'll be staying here in Australia, doing lots of stuff, which I do, but it's always a good time to sort of take stock and analyse and see where you are in your property investment journey. And that time over the New Year's is a good time to be thinking about that. So I'm encouraging you to use that to do your planning and thinking and manoeuvring and taking stock so you can take action in 2026 and beyond. I think we're going to be moving into some pretty interesting territory for property investors, and we can talk a little bit about that today as you get set for 2026. Joining him in the studio, she actually caught up with my colleague Leanne Garman about a month ago, and we've asked her to come back in because, allegedly he said that she was pretty good and we need more female talent on the show. So we've got her back, Dawn Fouhy, and we're going to chat about specifically the Melbourne market or the Victorian market and whether or not it's too late, whether or not it's too early, and everything in between. Dawn, how you going?
Very well,
Welcome
Phil.
back.
Thank you. Thanks, mate.
Do you know how hard it is to get female talent onto the show?
Why?
I don't know.
Maybe they're scared.
I don't think so.
They're scared of the sparkly blue eyes, Phil.
Could be. Could be. Yeah, it's like we've been podcasting for 10 years, and I'd actually hate to see our statistics on male and female participation.
There's so many successful female investors out there.
I know. Typically, they're the most successful investors, but they just don't want to tell anyone.
No, and that's the hard thing.
Yeah.
That's the hard thing about it. It's so interesting you're talking about Christmas as well. I can't believe it's
crazy.
11 weeks to Christmas.
It's bad.
So the last auction weekend will be December 14th. So you need to get your ducks in a row
If you're gonna do
quickly.
something.
Otherwise, you're looking at next year
Yeah.
with everyone else.
So now that you've done one of these podcasts, what would you say to all those female investors out there and people in and around property coming on the show? Do it. It's good fun. It's
Do
okay.
it.
Yeah.
It's amazing. And I think as well that as women, and I don't even know if it's necessarily a male and female thing, I think people are just, and it's in Australia, it's in Ireland as well, there's a lot of tall poppy syndrome. So people are scared of saying what they've achieved because people are very quick to cut you down and say, oh, but it's because she's this, or oh, it's because he's done that.
Yeah.
So I think that's a lot got to do with it, and especially on social media. And yeah, people are very quick to judge.
They
Phil.
are quick to judge, but it's a friendly audience, this, and people that tune into this podcast, and whether it's sort of audio or on video, they're property investors. So, it's just people trying to work out and help other people do it better. How'd you chat with Liam go? Did you enjoy
Yeah,
it?
really
It's
good. Yeah. Liam is awesome.
He's okay. I wouldn't say awesome.
He's great. He's really good.
He's pretty good.
Yeah, such a lovely guy.
What did you guys chat about?
We talked about our property portfolio and our journey. So Melissa and I, and our journey to a $10 million portfolio. And we talked about how people need to be realistic if they're on an average wage as to what they can build, contrary to marketing out there. Unless you have a really good income, you're not going to build a $10 million, $20 million portfolio, but you can achieve freedom. It might just not be 10 properties today.
And that's the point, right? Because, and I think I've spoken to this probably ad nauseum now, people have said it. But we did a survey of listenership and readership and all that sort of stuff probably 6 months ago, and it was a really good balance for me because it just reinforced me that most property investors own sort of 2 to 3 properties, and if you consume social media, you would think property investors all have 30, 40, 50 properties worth 80, 90, $100 million. That is just but a fraction of property investors. So you've got to put things into perspective. If you've got a $10 million portfolio, already that's one of the biggest you would think for property investors in Australia. But it doesn't really get the air time that's exceptional. It's not 50 or 60 or 100 million
Correct.
dollars, right?
But 2 or 3 properties is also exceptional
It is.
on an average wage
Yeah.
because it can get someone mortgage free or it can give them freedom of choice. if they want to retire at 55. And it's not all about them transitioning to cash flow assets. We know people who've just held the assets and they sell off one asset every, 5 years and live
That's
off
enough.
of the profits.
Pretty good.
So just keep it simple,
So you
Phil.
guys built
Everyone
a
complicates it.
$10 million portfolio as nurse and a couple.
$4 million. So
Wow.
this is the thing. So we were on 220K combined income and we built a $4 million portfolio. Caveat, we had savings. I was working 2 jobs. It wasn't handed to us. And we took risks, those pepper loans of 8%, and really pushed ourselves, figuratively balls to the wall.
Are you allowed to say that?
I don't know. Are you?
I don't know. It's okay, you can, because I just went, I'm allowed to say that. Means you're allowed to say it.
Yeah, exactly. Don't be scared, Phil. It's all okay.
That's all right. Okay, that's all right. That's cool.
Yeah, so you just have to, take chances and execute and keep going.
Yeah. So you guys are going to keep going. It's not what I want to talk about today, but you guys haven't stopped. You're going to keep cracking on.
Well, this is the interesting thing. We have an enough number. So I think a lot of the time business owners or even people on higher incomes, they get carried away and they keep pushing, but for what? So our sole purpose is like a happy family and freedom of choice. Anything outside of that is, icing. Our business isn't using clients to scale to supercars. Our business is to really look after people and help build purpose through building portfolios.
Yeah. So you're enough yet? Is that a number for you guys? Like, do you have a number?
It would be like a paid off PPOR, number one. The interesting thing is the Melbourne market looks great at that middle ring budget at the moment. So we're always looking. We can't help but look at something with an investment lens.
Yeah.
And then an enough figure, we would aim for kind of, 400K net passive income a year.
That's pretty good.
And a paid off PPOR. That's the goal.
You're living well.
Well, why
On that
not
basis.
try and aim for something that you can achieve, and also to show we have a 5-year-old, show our son that this is possible.
So you got a funny accent. Do you reckon you'll be able to achieve that back in Ireland?
No. Oh, actually, do you know what? I'm going to back myself and say yes. Do you know why?
If you knew what you know now.
If I knew what I know now.
Yeah.
The vacancy rate is so low in Ireland. So low. There is a mad rental crisis in Ireland.
Okay.
Because the lending is really restricted there since the Celtic Tiger fiasco. Where, we had people were being lent money like nothing else, oversupply, and property prices dropped 40% there.
Yeah. It's changed.
Around the time of the GFC. So it's all changed there. Lending is really tight and there's a supply constraint.
Yeah. Which probably makes for a good market.
It does. But would I know what I know now living in Ireland?
You probably wouldn't.
I don't think I would.
Is it? I haven't been out to Ireland for a while, but is property investment a big thing out there? Because
No.
I've got some colleagues of mine who are Irish and they love it. They're getting stuck into it, but it's not a big thing over there. Like, you probably don't talk about it as you would here in Australia.
No, and it's that same thing where people are uncomfortable talking about their success, and it's very much like, oh, you don't say that you're doing well or that this is happening. So I think, it would be more so frowned upon.
Anyway, I want to talk to you about Melbourne, or maybe Greater Melbourne, because Geelong fall in the Greater Melbourne.
It does.
It does?
Yeah.
Yeah. And I'm sort of looking down there myself at the moment, like pretty much every other Australian property investor. So we'll get stuck into that because I've got some questions around it. We'll just go to a quick break. Stay with us, back in a moment. G'day, welcome back. Phil Tarrant, host of the Smart Property Investment Show, here to talk to Dawn, with Dawn, around Melbourne and Geelong. And it's getting a lot of headlines and airplay right now. I spoke, and one of the fortunate things about what I do for a living, I can pretty much talk to anyone in Property Australia and they'll take my phone calls or hear some of my silly ideas that I have and I'll sort of trial and stress test it. And I heard from a number of different sources that the Melbourne market specifically, and I'm going to badge up Geelong into this as well, and let's just say those bigger regional markets in Victoria as well, the inherent fundamentals of those markets, and this is going to be a contrarian view, but I'd like your view on it. The inherent fundamentals of those markets should not be driving price growth as much as what it is, and largely a lot of the shifts in certain markets in Melbourne is driven by investors using buyer's agents. Discuss. Do you think there's?
I love it.
Do you reckon there's relevance in that?
I 100% think there's relevance in it, and that's why we don't buy in certain pockets that are heavily investor led. So a future-proof property to us is we buy with your future buyer in mind. So we want owner-occupiers to fight over it. That's why we haven't bought in Broadmeadows like every other Sydney investor that's piling in there. I would get them to hop on a plane, fly there and drive through the streets of Broadmeadows and then come back to me regardless of 15 kilometres to the city or whatever you want to tell yourself to make yourself feel better about buying in an area like that. So my main focus on Melbourne is its relative affordability comparative to Brisbane and Adelaide at the moment, number one. Number two, you will not make money everywhere in Melbourne because Melbourne is as flat as the eye can see. It is a paddock. And if you buy in an area with high building approvals, you may as well have not borrowed money at all because you're not going to outperform.
Yeah. So there's a lot to it. And Melbourne's got this blanket, and Geelong and maybe places like Ballarat and stuff like that, Bendigo. So bundle all them up. It's getting hyper-focused right now from everyone who's out there sort of, telling everyone this is the next hot market. You need to be in this place because it was going to whatever. I get that. All those things that have kept the Melbourne market subdued up until this point and not and performing worse than your Brizzies and your Adelaides and your Perth is inherently still there. Nothing fundamentally has changed other than everyone's talking about Melbourne and this is the right time to buy. And look at already the capital growth that's taking place there. So
correct. Well, supply has dropped though as well. So when I think about where we were buying 12 months ago versus what it is now, so Frankston, North, Frankston, like the clients have made like 150 to 200k in 8 months simply because there was no supply. So then what we're seeing on the ground is gentrification in motion, first home buyers competing against investors and beating them. So it's not just the data might tell one story, but seeing it on the ground, I've never queued with so many people at inspections. And a lot of them are home buyers. Yeah.
And now we're a month or so in of the 5% first home buyer guarantee scheme. Right?
Yeah,
so.
well, that's just getting rid of LMI. And at the end of the day, people forget that a lot of first home buyers are actually in their 30s on considerable incomes that have rented for a long time. So what we're focused on is the 750 to 850 market, where it's higher socioeconomic, where there's scarcity and it's affordable.
So 750 to 850, which is a nice price point for Melbourne.
Love it.
Because you're already out of the 500,000 and 600,000s, and that's where a lot of people are playing, investors and also owner-occupiers. So if you get up to your 750, 850, you're sort of probably more sophisticated investor with a bit more capital and or owner-occupier orientated borrowing. And this, I think the average age for first-time buyers is like 38 or something like that. Like it's not this sort of dream of a 21-year-old just got married and raising a family in the burbs anymore. Like it's a very different paradigm now. Yeah. So that price point for you, 750 to 850, is that why you lock into that? Because it's where there's a lot more margin for value?
That, and also we really look at how much are people earning a week in that area and what is the difference between what they could afford and a mortgage. So what is the relative affordability? We'll extrapolate that out and say, jeepers, this area is super undervalued.
Sorry, did you say jeepers?
I did say jeepers. I'm from the 1920s. Jeepers
is brilliant.
Well, there's something else I would normally say.
There's
something else I would normally say, but can't say that on air. So normally I'm like a sailor, so I really have to censor myself.
No, jeepers. I like it.
Jeepers, Phil.
Well, to be fair though, I keep this show PG, and
well, people could have their kids in the car listening to this.
Absolutely, and someone said to me once, because I'm not on air, I never swear. Like, I might have done the occasional S or something or other, right? But when they went, Phil, when we're a family, we drive along in the car, listen to the podcast because it gets our kids asking really curious questions around wealth creation, which is brilliant. So thanks for using Jeepers.
Jeepers creepers.
Jeepers
So,
creepers.
Speaking of jeepers
Yeah.
and talking about these affordable areas, I think it's important we give the listeners some value and actually talk about some suburbs that
Absolutely,
are
that's what I want.
looking good.
Okay, do that because people go, that's really good, Phil. Don't talk about that. Just tell us where to go.
Yeah. So, where I see value and why. So,
Okay.
I'm going to move around Melbourne a little bit.
Perfect.
The main focus is on scarcity, affordability, and low building approvals, folks. So,
Hang on a second. What are those? What's those called things?
scarcity,
Scarcity.
so low supply,
supply.
affordability for the local demographic, or bolstered by areas that are more expensive where people are getting priced out.
Yep.
And low building approvals.
Okay, so low building approvals means you're not out in those greenfield areas on the fringes.
Absolutely not. We're not buying in Tarrant. We're not buying in Truganina. We're not buying in any of these places.
Sorry, I'm just getting my map up. So I can follow you
Beverages,
around.
whatever.
Yeah, okay.
So, Williams Landing, and this is one of my favourite spots actually. I like this. There's a real, this is going to sound really like a wanky phrase, but it's an ecosystem of strength, Phil. Ecosystem of strength. I know. Around your Williams Landing, Point Cook, Hoppers Crossing, and Werribee.
Okay, I know where Point Cook is.
Williams Landing is right next door.
Okay. So that's around the peninsula, isn't it?
No. You're in
Point
the
Cook.
west. You're in the west.
In the west. Point Cook. What's that? Hang on. Where am I going?
Williams Landing.
Okay. Sorry, guys. But people actually think that I know about property and I don't. Williams Landing. Here we go. Yes. Okay.
Stock on market is 0.19.
Okay.
Days on market are 36 and dropping. People there earn $2,600 a week. And that's from the 2021 census. And I can tell you that the cars and the driveways are a lot nicer than a $2,600 a week income. 65% owner-occupiers. 19 kilometres southwest of Melbourne. The price disparity. This is my favourite. So people get stuck looking in regional areas for $650. Have a look at townhouses in Williams Landing between $680 to $720 because 4-bedroom houses in that area are in the 900s. The yield, look, it's not going to blow your socks off, but it's the yield today on purchase price is 3.8%. This is what I want people to focus on. The vacancy rate's tightening, rents will rise. Never focus on what your yield is today. Focus on what it could be tomorrow, next year. Capital growth's going to get you free, folks, not your 6% yield in the middle of nowhere.
That's good counsel. And a lot of
Wyndham
people...
Vale LGA, the building approvals are 0.9.
Okay.
If you want somewhere cheaper in the 700s, Hoppers Crossing, amazing. Building approvals are 0.2%. Get an established house on 600 square metres of land in the 700s, low 700s. It's getting that ripple effect from Point Cook and Williams Landing that are more expensive.
Yeah, so what you're talking about there is this sort of clustering effect where you might be priced out of a particular suburb, but the suburb next door, north, south, east or west, might be the next best place to be investing.
Correct.
Because the same thing, people are priced out, so they like the area, they keep moving out. And it's got everything there. There's train lines, there's a Bunnings.
It's got everything. But
And that road, the Princess Highway, okay, get you straight into town.
But also look at the fact that don't just look at one asset class either. So if you only have 550k, there's no reason for you to be buying in the middle of nowhere in a town of 8,000 people. Have a look at townhouses around these areas, around Werribee, around Hoppers Crossing. As long as there's not 40 in the complex and you're paying extraordinary body corporate, find that townhouse that stands out. If you're a first home buyer, the relative affordability, you're talking about the first home buyer scheme, that's huge. You can't build those things now for that price.
No, it's replacement value. And what about sort of into Point Cook, or is that sort of...
Yeah, no, really, they really like that as well, but that's a bit more expensive, so there's a bit more yield compression there. Really like Seabrook as well, so that's in the Hobson's Bay LGA. Typical price there is about 800,000. Stock on market is 0.23. Days on market are 32, and the vacancy rate's 1.8. So there's
Seabrook.
Seabrook. It's tiny. It's a tiny little suburb near Altona.
Okay.
So closer in again.
Yeah, just north of Point Cook.
And these are all landlocked areas. You know, you're not getting that supply issue that Melbourne has going against it. Because I don't want to paint a picture that's all roses and sunshine. You know, Melbourne has a state government that isn't very investor friendly. You know, we have very tight regulations as far as, you know, rental compliance and standards, which I feel will probably end up happening across the country anyway, because they're just basic things that we should be providing as investors.
Yeah, to be fair, yeah, I would agree with that sentiment. If you're a property investor, you've got to be providing a property fit for purpose. So
correct.
And lessons, not all property investors have always had that particular mantra. So
yeah, but they should.
You've got government regulations sort of coming in, and it was sort of become a bit more normal. One of the reasons why Victoria's sort of hasn't been an attractive asset up until recently is because like changes the land tax and all that. But how much more can they change? Who knows?
Well, this is the thing, but our Queensland properties actually cost us more to hold than our Victorian properties because our insurance in Queensland is triple that of Melbourne. On average, it's $800 a year in Melbourne for insurance. So
for a freestanding house?
Yeah, so it all like works itself out. Unless you're buying in a, you know, really low socioeconomic pocket, then your insurance might be more. So the thing I really like about Melbourne as well is the population growth. And of course, the building approvals are built into that. That's why they are building so much. But by 2035, they're predicting that the population in Melbourne is going to grow by another 1 million people.
Yeah.
Like, that's significant.
Yeah, and where you're looking at here, and I quite like this pocket, that Altona, Seabrook, Point Cook, Williams Landing, it's all bound. You know, it's south of the Princes Highway. There might be some infill through there, but there's certainly not greenfields. It's pretty established.
Not at all.
And
it's relatively affordable. So this is what we're talking about. It's not just that it's Melbourne's turn. It's relative affordability to our other capitals in our country.
And what do you say with places like, say, moving close to the city then, this logic, and maybe it's a price point thing like Altona North, Footscray, Williamstown. It's just getting more and more
opportunities.
Expensive. But,
yes,
yeah.
But if you are somebody who, you know, you have that sort of capital to play around with, my advice would be to go for it, because you look at anywhere in those middle rings of, you know, Brisbane, Sydney, you're talking about millions. In Melbourne, you can still get it for 1.5.
Yeah.
So relative, again, it's affordable.
And I think a lot of people, a lot of investors, and myself included, you end up on the other side of the bay normally when you're looking at a property like, you know, your St Kilda's or your Balaclava or your Prahran, you know, St Kilda East, Albert Park. But on the other side of the bay there is it's sort of a bit forgotten. You know, I don't hear a lot of people talking about that area. Maybe we just wrecked it because everyone listens to the Smart Property Investment Show. But
well, we've been, it's a great area. But I'm going to take you across the other side of Melbourne now, because I don't know if many people talk about this area.
Well, let's do that. Let's go to the other side, the eastern side of the bay. But we're just going to go to a break. Let's go to a break. Okay, stay with us. Back in a moment. Welcome back, Phil Tarrant, host of the Smart Property Investment Show, chatting with Dawn Fouhy, who is the co-founder. Is that right?
Co-founder.
Future Proof Property Investing. Did it take you long to come up with a name?
No, it didn't. Yeah. But then when I started to say it, I was like, oh, lucky I don't have a lisp.
Yeah.
Future Proof Property Advisory.
Do you call it FPPI yet?
Oh, no, I should though. FPPA.
Future Proof.
Yeah. And it is future proof. This is a future proof suburb, Phil.
So what does future proof mean to you?
Future proof to me means that it's a property that isn't going to be affected by AI or technology, or it's a future-proof asset that an owner-occupier will always want to buy. So it can't have any detractors. So a future-proof property is never on a main road, not on a flight path. It's something that somebody at an auction is going to bid ferociously for, no matter what the cycle.
That makes sense. So there's no hairs on it.
No, definitely not.
And typically people, they'll start erring towards, I can justify it's on the main road, but maybe it's going to get rezoned, or it's this. But eventually, someone's still got to. Your property needs to be sellable.
Correct. But you
at
do
all
something
times.
right once and, it's done. People are always looking for quick sugar fixes.
Yeah.
I think just time the market for short-term equity and hold the thing. It takes 10 to 15 years to see those results where you're going to get that amount of freedom, and you just need 2 or 3 assets in really good locations. Serve yourself well.
Yeah. Okay, so let's go to the other side.
We're going to
the
go
bay.
to somewhere called Doreen, like the name.
Doreen.
Doreen in the city of Whittlesea.
What? I've never even heard of that
Well,
before.
here I am, Phil, telling you about all these areas
Doreen,
you should
Victoria.
be
Here we
hearing you
go.
about.
Oh, yeah. Okay.
Set and forget assets.
Doreen's up. That's northeast, correct?
Correct.
Melbourne.
So
That's-
about 26 kilometres northeast of Melbourne.
Okay, so I'm looking at my map here, and there's a lot of green around it, which means that
Yeah, no, but these areas in particular are fully built out. So Doreen and Mernda, the building approvals are, I think it was like 0.7%.
okay.
And the owner-occupier activity on the ground is, I would say, ferocious. So you have a lot of like cops, nurses, doctors, really good private schools around there, excellent fundamentals. Stock on market is 0.3 and the days on market are 21. Really low inventory levels and a vacancy rate of 1.3. So this is for your type of investor who just wants something that's a bit newer. Land size around 450 to 500 square meters. Not every investor, Phil, wants the large block in the older house. Some investors just want a higher socioeconomic pocket where it has the propensity to double over the next 10 years.
So you're getting at Doreen now. You're actually getting up to where there are some hills in Melbourne. It's sort of capped out with that mountain range just above it. So
Correct.
So
it's hemmed in by
it's
that.
hemmed in. Yeah.
And I just like it because of the family-friendly vibe, and it's really nice out there on the ground when you're actually out there.
It's quite green and leafy in and around
It's
it as well.
beautiful.
It's really nice. So that looks like a first home buyout slash a buy a
Upgrader,
house to
it
raise a family out there. Yeah.
Correct.
Yan Yean. Have you been to Yan Yean before?
Yes, so Yan Yean is a road, so quite a busy road. So it's I would encourage people to, if you want to set and forget investment, have a look at Doreen and Mernda.
Okay. That's cool.
Are we going to talk about Geelong? Are we going to let everyone in on the secret of Geelong?
Well, I don't know about Geelong.
What?
Well,
Go on.
Geelong can just keep going out forever.
Correct, but you need to buy in the right suburbs in Geelong.
Yeah, so like I'm thinking like places like Lara and stuff like that. There's just that can go on forever and ever and ever and ever and ever. So when will, and look, Geelong's a big city.
Did you know though, Phil, the Regional Movers Index said that Geelong is the most popular area for relocation within Australia. It captured 9.3% of the total net internal migration, and it overtook the Sunshine Coast last year.
9.3%. So more people move to Geelong than
Then
the Sunshine Coast.
Coast.
So you don't hear that normally.
No, so they're here, I'm telling you. And I love it because it has a mix of lifestyle and affordability. So I'm always trying to think ahead and think, as Melbourne Metro becomes more unaffordable, what about these major regionals of Ballarat, Bendigo and Geelong? What are people going to want in a home? They're going to want, a backyard for their family and a nice house that's affordable. So Geelong's current population is 300,000. It's a very large city. And by 2034, it's going to grow by 90,000 people. And it's an economic powerhouse. So its GDP is 20 billion.
Is it 20 billion bucks?
20 billion. They're building a new women and children's hospital that's 500 million. It's very strong economically. It has an airport near there, Avalon, and it has one of the best private schools in the country that Prince Charles, I think, actually
Geelong
did a
Grammar.
term at.
Yeah.
Yes, Geelong Grammar. So if you have 50 grand a year to send your kid there, and people do in Geelong,
And lifestyle, it's on the bay as well. There's lots you can do.
it's great. It's
Yeah.
close to Torquay, Lorne. It's Lorne is kind of like the Noosa of Victoria.
Yeah, Lorne's pretty cool.
It's awesome. The Maryvale Group have, purchased 2 venues down there. They have a Toddy's in Lorne. So if you're from Sydney, there's a lot of money in those coastal areas around Anglesey, Lorne, Geelong.
Yeah, I've been to Avalon Airport a lot, but I've never actually been downtown Geelong. I should do that one day.
Really like Geelong. So what I would say is that Hamlin Heights, you can get some bay views there in some pockets, and it
Hamlin
has
Heights.
real low building approvals.
Okay, where's Hamlin Heights? Is that on the...
It's near Bell Park and Bell Post Hill.
Okay.
Now, Geelong is 70 kilometres from Melbourne, so you can get into Melbourne in an hour. When I used to be a nurse, I used to work with people who used to drive up from Geelong as well.
Every day, just commute.
Yep. And it's 100 kilometres from Ballarat as well. Really like Hamlin Heights. Belmont is a great suburb as well.
Yeah. It's sort of more downtown.
And Leopold is a cheaper option that has lower building approvals. If you're looking for something under 700k, I would have a look at Leopold. And if you have more money to spend, I would look at Hamlin Heights and Belmont.
And for those of you who are tuning into this, I'm just on my phone. You can probably see me if you're watching it. just looking at suburbs on this. And you know, this, and for me, I'm probably a good investor in that. I just look at the numbers. Like
I just look at numbers as well. That's it.
I don't know. I know of Geelong, and I know it's quite a vibrant area, but then when you dig down into this, there's got to be 30, 40, probably maybe 50 suburbs in Geelong.
Correct.
Which are all individual, have their own nuances and different price points, and you know, and if you don't know what you're doing, you just can't throw a dart and think anywhere in Geelong is going to be good. You've got to be.
You
very
would make a
specific.
mistake very easily.
So is there any mistakes in Geelong? Like where would you not be? Yeah.
Supply areas. So I think Lara's building approvals were 6.8%. Yes, you can get cheaper homes there. So you could argue that the rebuild cost is still less than you buying established. So
You're a long way out of town though.
you are. So and that's the thing. Norlane I'm not keen on because it's got 80% of public housing. So not that there's not saying that public housing areas don't grow, they do, but for me the type of investing I like is easy. So I don't want tenant issues as much as I can prevent them.
Yeah.
So if I get growth, sure, but I don't want someone ringing me saying something's happened to my investment.
Yeah. It's a hassle you don't really need.
There has to be a sleep at night factor with investing as well.
Well, that's what it should be, right? You know,
Yeah.
but people always say, "Oh, real estate investing is really good because it's passive. You don't have to be, you know, once you buy it, like you still got to be very, very active. You got to be, you know, always considering your asset. Is the mortgage right on it right? Is the rent on it right? Do I have the right tenants in? Like it's, and a lot of people think it's glamorous having a large property portfolio. It's not. It's
not
just a
glamorous
lot of
at
hard
all.
work, you know. And people go, "Oh, woe is you. It's a first world problem," and you know, it's a real privilege to own quite a lot of property, but you know, you've got to be stuck in. You've got to get into it.
Speaking of, what are your plans for 2026, Phil?
Don't know. It's all secret. It's all secret.
Are you buying?
I am. I will be.
Yeah.
Yeah. I will. I am looking in and around Melbourne at the moment. So,
There you go. So
but
do the yields not scare you, Phil?
yields don't bother me
Why?
because I'm not buying for yield.
Exactly. So you're buying
Is
for
that the right
capital
answer?
growth. Yes,
Yes.
it is.
Yeah. But it's a cash flow play, right? I can manage the negative cash flow.
You can.
And obviously, I always look at property investing before there's any tax consequence to it. Is the right way to look at it. But yeah, like you know, I want to deploy my capital, get the greatest growth possible.
But do you think you would be where you are today without capital growth? So would you always buy for capital growth over cash flow?
Yeah. Yeah.
Same.
Oh, well, but I have a diversified portfolio, so I do have assets, commercial assets, which provide good yield, right? And like most people, you start off in resi, and then you would graduate. It's probably the right term into commercial property, and yeah, depending who you chat to, they would say a good portfolio would be 50-50, maybe 50% commercial, 50% resi, but depending on where you are on your on the life cycle instead of property, you might end up 80% commercial and 20% resi. Who knows? Depending what you want. But eventually, you want income replacement with property, and
Correct.
You would probably rather having good income replacement without having to sell down assets. But if you buy well, it means, to your point, if it's future proofed, you can sell those assets to someone else at a point in time for much more than you paid for it. And
Absolutely.
a lot of people try and make property really, really complicated, Dawn. It's not. It's really, really simple.
It's so simple.
And if someone tells you some scheme or some strategy that you go, nah, that's not for me.
Phil, we've never picked up a paintbrush. We've never renovated any of the properties. We've just timed them well. in areas where people want to rent and areas people want to live, and the portfolio's done the lifting.
Yeah.
I always encourage like our clients or anyone in our circle to focus on their career, focus on their business as their cash flow.
Yep.
You're young, get out there, you retire, you expire is what I say. You've plenty of time to do that later. Just get after it. And 2026 is such an exciting time in the market, and it's not just about Melbourne and Geelong. I'm keeping a very close eye on the ACT. I know you're like, shocker.
Wow.
Parts of Tassie and parts of South Australia. So stay tuned, folks.
See, ACT is an interesting one because we're in a particular government cycle now where the government of the day want to be big government. And I think the government of today will be the government that we're going to have for a little while yet. So, and you can have a view on that politically, but if you look at it through the lens of property investment, the government is getting bigger and bigger and bigger and bigger at both a specific at a federal level, but also at a state level. And a lot of money is going to government-orientated projects. So,
Correct.
you know, there should be some bearing on property prices in Melbourne as a result of that.
Correct.
And sorry, not Melbourne, Canberra.
Canberra.
Yeah,
And they earn a lot of money in Canberra as well.
they do.
And some of the house prices in areas that are high socioeconomic are only relative to their income are 800,000.
Yeah.
So I'd be keeping a close eye on some suburbs in Canberra.
Yeah, I quite like the belt between Canberra and Sydney because that's just going to fill in.
Same.
That's just going to fill in eventually the whole way through there in time. So land banking out that way is sort of quite attractive as well at the moment. But who knows? When I work it out, I'll tell everyone.
After you've bought it.
After I bought it. Then I'll just tell everyone where to buy.
That's what you do, right?
Oh, yeah. Everyone knows it. It's funny, people go, no. But when we started off investing, we bought heaps out of the western suburbs of Sydney back in mid-2010s. And, we narrated the whole thing the whole way through. Nothing was a secret. So we're going to be doing a lot more of that in the future because people like to know where other people are buying.
Yeah,
and there's
100%.
so much misinformation out there. I'm big
I think so.
on people making ill-informed decisions on the information they have, and you know, you have misinformation and disinformation. They're two very, very different things. Disinformation when people deliberately put inaccurate information into the market.
Yeah, terrible.
And that is happening. Misinformation is when people hear that and think it's accurate and just keep propagating that same information. So they might not deliberately or nefariously be giving inaccurate information, but it's, misinformation. So
Correct.
a lot of people are making big decisions with their money on what is a very, very noisy market right now. And
I agree.
There's so much. If you've an idea, you can go and find someone to reinforce that it's the right idea for you, and you've got to be very, very careful.
I think that's why a lot of people are stuck in analysis paralysis as well, Phil.
Yeah.
I think people have lost the art of actually executing. They're seeking validation from every forum, everybody out there, but they're not actually taking action. Yeah. It's like, they're yield frigid to Melbourne, but they're not looking at other assets within their budget. So the units, the townhouses, and yes, I said a bad word, I said units, but you're talking about a first home buyer scheme. What do you think first home buyers can afford in a metro city?
And this is the point. I think under the new scheme, and I'm probably going to butcher this number if I got it wrong, please don't give me a hard time around it, but pretty much under that new 5% scheme, it's opened up 70 or 80% plus of all unit markets in Australia.
I agree, because in Melbourne, it's up to a value of 950,000. And, we actually recently secured a really nice townhouse for 530,000
there you go.
in Metro Melbourne.
There you go.
Three bedrooms.
And you speak to all the economic commentators around it and real estate, data mob, and they'll say the disparity between houses and units is the most disconnected or disjointed it's been in probably our history. And it shouldn't be structurally that far apart. No. So I bought a unit in Sydney last year, like purely on the basis of it was just so disjointed, So there's a lot of value in units.
You saw the opportunity.
Yeah. So I wouldn't be dismissive of units in well-placed units and the right sort of units in Melbourne. Like, I got an email the other day someone saying they bought in Docklands and they know how much I dislike Docklands because I went on.
I agree. Why did they buy in
rants
Docklands?
recently? I don't know, but like there is places to buy units and there's places not to buy units.
Not Docklands.
Yeah, but I think they bought years and years ago when they were told it was a really good place to be. But and even though the location might be great, there's still bad units you can buy in those locations. And buying into these massive complexes with huge strata fees and no uniqueness or scarcity, all those things that you spoke about. Like, if the idea of property investment is to deploy your money to get the biggest return on it, that's possible. It might not be where you should be, and it's very, very simple. So there'd be huge swathes of Melbourne I wouldn't be putting money into.
Oh, absolutely.
Into units. There'd be some areas where it's really cool, really good spots. Small blocks, 4, 6. Units in well located and priced areas.
Have a look around West Footscray. Have a look around Essendon. There's really great pockets around there. Even down around Mentone, Hyatt. There's amazing value on the Mornington Peninsula. Around Mornington, Mount Eliza. There's Melbourne Metro will suit every budget. You just need to be one of these people that's brainwashed by land to asset ratio. You need to understand what your budget can buy, and your budget dictates your brief. And I know if it was my son, I prefer for him to have an asset in Metro Melbourne now that's affordable than owning something in the middle of some mining town just because it's good yield. I don't prescribe to that.
There you go. Well, thanks for coming in, Dawn. I enjoyed chatting. So you're going to come and have a chat with Liam again in another month's time?
Would love to.
Do you know what you're talking about yet? Are you going to work it out?
No, I think we were actually going to discuss, and it's very timely you say this, we were going to talk about capital growth versus cash flow, the age-old debate.
Yeah. If you can get growth, both, great. If you've got to choose one of them, choose capital growth.
Yeah.
But then again, that's not advice at all. It's
not financial advice at all, folks.
Not at all. Disclaimer. But as a mantra for most property investors, you're probably investing for cash for capital growth, not cash flow.
Correct. Cash flow comes later.
Yeah, cash flow comes. If you buy well, cash flow happens. And we've got properties in our portfolio, sort of certain trusts where you see it, they've been negative and they just become positive. And if you don't refinance your properties, eventually they'll become cash flow positive.
How many properties do you hold now, Phil?
It depends who's asking.
I'm not the ATO.
No? Oh, well, I know the ATO listens to this, so I'm not big on the number of properties. In terms
What's
of the
your value?
I don't disclose it.
Don't you?
I don't need to.
Amazing.
Yeah.
But if we were to say, you would obviously be in the 0.001%.
I'd be one of the larger. I'd be on the larger side of property investors.
Yeah. So
not
somewhere north of 40 million.
It's the portfolio I've got. It just keeps growing and evolving.
Yeah.
And the sort of assets
done.
I buy today are very different to the assets that I was buying 10 years ago.
You have to evolve with your portfolio.
And this is the point, right? I don't need to buy 4-bedroom homes in the suburbs anymore.
No.
I've done that. They've been really, really good foundational properties.
And that's how you start.
Who have given me the capital growth to be able to deploy into more sophisticated investments now. I'm not big on. I wish I had less properties. Because it sounds horrible. It's just more things you've got to manage. And for me, and this is sort of a bit of a misnomer in the market. I don't want to give away too many secrets, but people think I spend all my time in property. Like property is like a minute fraction of where I spend my time. And in terms of my bandwidth and priority gets very, very little. It's very, very little. The reason why is because I future-proof my portfolio. If I'm not doing anything, it's all okay. Sometimes better not do anything. Just sit there.
Just leave it,
Yeah. And look, I'm big on making sure I got market rents and my mortgages are right. They're probably the two things I concentrate on mainly. Are the mortgages right? Are they? Is it a fair mortgage for the market as is right now? And I make sure I keep right on top of that because that helps with your cash flow. But largely the properties just keep going.
You let the 8th wonder of the natural world do the rest.
Absolutely
Compound
compounding.
growth.
And when I get frustrated with, and I probably said this before, when I get frustrated with property, which I do, by the way, I just go, I sometimes find it a bit fatiguing because you speak to a lot of people in property and everyone loves property. I just go, I don't have a love affair of property. I like the outcome it gives, but I sit there and I just go, I just can't be bothered with all this stuff. And again, this is like a first world problem, if you want to call it that. I just get my capital growth calculator out and I put my number in, and then I just go, okay, let's assume 5% growth for the next 10 years. And I go, I can live with this.
Of course you can.
I can live with this. And that's how I sort of rationalise it every time I get a bit annoyed with it. And then on the flip side of that, I'll sit there and just speak to people like you and just go, I really don't do enough. I should do more. So anyway, that's the problems I've got. But I look forward to staying in touch, Dawn. That's
Absolutely.
Cool. Yeah,
thanks, Phil.
That's great. How do you track you guys down? What's the best way to find future-proof property investing?
So we're very unique insofar as we're not one of these buyer's agents that's scaling with staff. We decided not to. Okay. We're very boutique. So you can apply to be a future-proof client via our website, and we help you build out a portfolio. You deal with me personally. There's 5 of us in our team.
Okay, that's cool.
And we're not churning and burning. You're not applying $200 for the month. We are really looking after you. That's what we do.
It's important.
100%.
What's your ideal client look like?
There's somebody who is driven. So they really have an innate curiosity. They want to learn and they want their ideas to be challenged. I want you to be in the driver's seat. I'm just helping you get where you want to go and helping you learn that investing can be easy, that you don't need to be renovating, and that you're not a developer. Like, remember, unless you can come to me with a feasibility and you know about developing, don't come and ask me for a development project, because I'll tell you right now, you're going to lose money. You're better off just buying assets in places where people want to live.
Yeah, I completely concur. Property development is only for certain people, and everyone, I know, they start down a journey and then they go, I'm a genius at this property.
Oh my God, I want a subdividable block. I'm like, you don't want that. You're paying for the land and an old house. It's going to cause you headaches.
There you go. Dawn Fouhy, co-founder, Future Proof Property Investing. It's good to meet, and go and track these guys down. It's quite a refreshing approach, Dawn, and it sounds like you guys are doing the right thing. So keep at it, and we'll get back on the show.
Thanks, mate.
That's cool. Thanks for tuning in, everyone. Remember, smartpropertyinvestment.com.au, or you can find us on the social media if that's how you like to do your stuff. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.